Welcome to The Explainer. Today, we're looking into our crystal ball for the year 2026. We're mashing up two huge reports, one from Deloitte and one from Scope Ratings, to give you a really clear picture of what the experts see coming down the pike.
All right, here's the game plan. First, we'll talk about why everyone's calling 2026 such a make or break year. Then, we're going to walk the economic tightrope, see how tech is just tearing up the rulebook, zoom in on how specific assets are looking, and finally, wrap it all up with a clear strategy for what to do. So, what's the big deal with 2026? Well, the word on the street from basically every expert is that this is not a year to just sit on your hands. It's shaping up to be one of those pivotal moments where the decisions leaders make are going to echo for years to come. And this quote from Deloitte just hits the nail on the head. We're not talking about just getting through another year, right? This is about actively grabbing the steering wheel and deciding the direction of the industry. The choices made in 2026 could really separate the winners from the losers for the next decade.
Okay, next up, the economy. And honestly, the best way to think about it is like walking a tightrope. And I mean a really high one. You've got some serious risks pulling you one way, but also some huge opportunities pulling you in the exact opposite direction. Deloitte basically lays out a fork in the road for the U.S. economy. Down one path, it's not pretty. Trade tariffs could kick off inflation, the job market gets squeezed, and the whole economy just stalls out. But on the other path is pretty much smooth sailing. Those risks never really materialize, and the economic engine just keeps humming along. So, what's actually going to happen? Well, the most likely bet is something in the middle. The baseline forecast calls for a little stumble, but then a recovery, with the economy growing at a pretty modest 1.4%. That's a definite slowdown, and it's basically a signal to buckle up for a bit of a bumpy ride.
Now, here's where things get really interesting. When you look at consumers, it's a tale of two cities. We're seeing a huge split. Higher income folks, they're expected to keep spending, growing at about 2.2%. But for lower and middle income families, spending is basically flat. They're feeling the squeeze, and that's a major drag on the whole economy.
So you've got this cautious economic vibe going on. But at the exact same time, underneath all that, there's a technological earthquake rumbling. Two massive forces, AI and stablecoins, are getting ready to completely shake the foundations of the financial world.
First up, let's talk about payment stablecoins. The big deal here is that new laws are finally giving them a green light. And by making payments way faster and cheaper, they could become a serious competitor to the old-school payment systems and maybe even start pulling money away from traditional bank deposits. And if you want to get a sense of the scale of this thing, just look at that number. Okay, even if you think it's a bit on the high side, a potential multi-trillion-dollar market is just wow. For banks, that's a threat you can't ignore. For innovators, it's a ginormous opportunity.
The other absolute game changer is something called agentic AI. And listen, we are not just talking about a slightly better Siri. This is a huge leap. We're talking about AI agents that can actually do complex stuff all on their own. It flips the model from AI helping a person to AI running the show while a person supervises. The potential here is just massive. But, and this is a big but, to actually get this right, Deloitte says banks have to stop just tinkering with AI in little side projects. You need a real company-wide game plan. That means having one clear vision, figuring out who's in charge, making smart choices about what tech to build and what to buy, actually measuring if it's making you money, and getting ready for what's next, like this agentic AI.
Okay, so we've got this cautious economy on one hand and this explosive tech on the other, but how does that actually affect investments? To figure that out, let's get really practical. We're going to zoom in on the European structured finance market using some fantastic analysis from Scope Ratings.
This chart gives us a perfect bird's eye view. Just let your eyes scan the colors for a second. See all that green up top? That's your consumer stuff, car loans, mortgages. They're looking pretty stable, even positive. But then your eyes drift down to that orange box for non-performing loans. And yeah, that's where the pressure still is.
Now, for commercial real estate, this is a big deal. After getting hammered, the outlook has finally been upgraded from negative to balanced. That's a huge signal that the market might be finding its footing, with prices stabilizing and investors starting to tiptoe back in. And you can see that stabilization right here in the numbers. Look at this. The vast majority of ratings were just affirmed, which means they're holding steady. The few upgrades we did see were in really specific, high-performing areas, like popular retail outlet villages. Now, the story for non-performing loans is a bit more complicated. The overall outlook is still kind of negative, but you really have to look under the hood here because not all NPLs are created equal.
And this chart shows you exactly what I mean. Just look at the orange bars versus the blue bars. It's like night and day, right? The orange bars, the newer loan portfolios, are collecting money at a much higher rate. The blue bars, the older ones, they're lagging behind because all the easy-to-collect debts are gone. All that's left are the toughest cases.
All right, let's talk about some good news. Things tied directly to consumers like residential mortgages and consumer loans are looking really positive. And why? It's pretty simple. Economies are holding up, the job markets are strong, so people can pay their bills.
This chart for consumer assets pretty much says it all. For the safest senior stuff, it's rock solid. But then, bam, look at the riskier subordinated stuff. A whopping 88% of them got upgraded. That's just incredible, and it shows how well the underlying borrowers are performing. Phew. Okay, so we've gone through the economy, the tech revolution, and specific assets. What's the bottom line? How do we put all these pieces together and figure out what to do in 2026? It really boils down to this. 2026 is a year of total contrasts. You've got these two competing ideas, right? On one side, the economy is screaming, be careful, play defense. But on the other side, you've got this tech revolution screaming, go for it, play offense. And asset performance is all over the map. So, the winning playbook? It's going to be about doing both, playing smart defense against the economy while having a bold offense to grab those huge tech opportunities. And that really brings us to the big, final question for 2026. In a year that's defined by both these headwinds and these unbelievable opportunities, what's it going to be? When we look back, will we see a year where everyone played it safe? Or will it be the year that the bold, courageous moves redefine the entire game? That's the question every leader is going to have to answer.